Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Gary Wagner from thegoldforecast.com. Gary, thank you so much for joining us today.
Thanks for having me.
Well, it's great to have you. Thank you so much for joining us live today from Hawaii. I hope it's great weather there. I did want to ask you about what we saw today in the markets. And it seems like we've been seeing a downtrend occurring in gold, silver, and also platinum. Your perspective on what is happening with the metals this week?
Well, we obviously had a shift in market sentiment and a dramatic shift at that at a time when I believe personally that what we witnessed was really technical selling and not so much based upon fundamentals. Market sentiment kind of wavered as many members of the Federal Reserve spoke this week. Powell had two speeches. In fact, one of them is the first time they've ever had him on air where he actually swears. He says, close the yup door. But he had people that came in behind him. But the key was that at first he said, we really don't want to raise rates. And I take that to heart and I believe that the Fed doesn't want to. But then he balanced it, and one of the titles of my article was Threading the Needle. He balanced it by saying, but we're prepared to do it if needed. And so as market participants interpret that, they can cling to the bullish or bearish kind of statements or effects it has on the metals. In this case, they pulled momentum to the downside, specifically in gold after it went over 2000. It opened on Monday at 1999 or 98, so really close to that. And they looked at that as a price point in which it was easier to short the market, and they built momentum. In fact, we had lower lows and lower highs the entire week, Monday through Friday, in gold, giving up about $60 in the futures market. I don't know, I would assume spot was about the same, but a really tremendous decline on a weekly basis, the largest since really September of this year.
It is a dramatic decline we're seeing. Your perspective on where we go from here, because obviously there are geopolitical tensions that continue to get worse. And it seems like, do you think this is a buying opportunity here as we see metals down? What is your take here?
That's a complicated question because is there a buying opportunity? The categorical answer is yes, but when is something that I'm not prepared to answer because as a technical trader, I have to acknowledge that fundamentals are first to move the market, but sometimes, as we saw this week, it seemed the technical aspects of the market held a lot more weight than what's going on in the world, fundamentally speaking. And the comments of Federal Reserve members, they are so good at trying to balance what they say, Fed speak, so to say, that you can take what you want from their statements because they talk out of both sides of their mouth. Powell saying that the Fed really doesn't want to raise rates, and I truly believe that. And then moving forward, adding that, but we're prepared to do it at any time if warranted. So the whole idea of data dependency. And so traders really took the momentum of the short selling today, I believe was strictly based on technicals because the fundamentals really don't match. The only thing out there was that we probably won't see any more rate hikes this year. The CME's FedWatch tool is about the same for the December meeting, but next year it does shift in March. And I think that what we will see is when a bottom forms, because I would have to get some sort of V formation on a chart. In other words, as the market's dropping, and yet I see fundamentals out there that should be supportive of the precious metals, especially gold, the safe haven aspect of it. I have to see some sort of V or confirmation that not only has it hit a certain low that I'm looking for, whether it's Fibonacci retracement base, or in the case of gold, the average base, because in a single week, gold broke through the 200-day, the 100-day, and the 50-day all in one week. That is a very rare occurrence, and they had some space between each of those targets. And so as a technical trader, I look at if the market's headed towards the 100-day, does it close hard below it? Does it stay below it? And so when it breaks through the 200, and us technicians look at 200 for the longest term perspective, intermediate, we look at the 100-day, and short term is 50-day. And I kind of am laughing when I say that, because when I was in my 30s as a trader, I looked at 7, 13, and 18 minutes as short, intermediate, and long. And that I wouldn't look at a daily chart, because I felt that I used to say, well, that's like watching paint dry. And now that I have aged a little bit, I really, when I look at intraday data, it's usually a 2 or 4 hour chart. I don't look at the short-term charts as I used to, because there's so much noise short-term that the further you step back, the wider of a picture you get, and the better you are at estimating where the market could fall to in the case of what we're witnessing, which is a dramatic decline in the metals this week, where it could fall to. The one thing that I will say is I believe that when this current correction is over, we are probably, or possibly I should say, see a strong rally to the upside. So to answer your question directly, is it a good time to buy the precious metals now? It depends on how you're buying. If you're willing to cost average and you're looking to accumulate for a long period of time, all of these dips are beneficial times. You don't want to buy as it's going up. But if you're going to hold it for a year, 2 years, 4 years, or in my case, as you know, because you're where I get my precious metals from, I look at it as, well, it's when my kids will sell it, because I'm buying it not to sell it. I'm looking to get it, to accumulate it, and pass it down. So I'm not concerned about what it's going to do this year or next year. It's where it's going to be in 5 years. And I do believe that when this current correction concludes, we could see a rally, but that's all contingent upon what's going on globally. You know, we've got conflict in the Middle East. We have conflict in Russia and Ukraine. We've got threats of nuclear usage by the Russians. And a lot of the articles I read said, you know, we're not taking it seriously. Maybe we should. I pray that it's just the threat, but I worry that it's not. And so there's a lot out there fundamentally that should be highly supportive of the metals. And when you step back and look at the big picture, even with this week's drop, for example, in gold, it's still above $1,900. And silver still above $22. And so it's fallen, but it's fallen from that, in gold, the level of 2000, which has kind of been that elusive magic number, because every time it's hit it, it's moved up higher, but at some point gotten whacked really hard. It seems to be a signal for technical traders to realize that the probability and the amount of money you can make on the short side is much quicker, and also much greater than by maintaining long positions. So I think that if you're the type of investor that buys and holds, because that's how I look at physical possession of precious metals, you're not buying gold rounds or ingots or bullion to sell it a month later. I mean, if I'm wrong, correct me, but I wouldn't think that that's how the normal investor is doing it. It's important, I believe, that everyone has a component, a percent of their portfolio in something you can hold in your hands. It's the only asset that you really can hold in your hands. You can't hold land, you can't hold stocks. It's the one thing that you can physically hold and walk with you. And so it's an important component. Those that are aggressive buyers that are looking for more short-term moves in the market, 3 months or 6-month moves, they might want to wait till we get a confirmation next week whether or not it's going to move lower. If it does in gold, I'm looking for around 1920 to 1900 to be really strong potential technical points of support, and even more important, critical points if they're broken on a closing basis. That's what I would look for right now.
As you mentioned, I think it's important to distinguish between those people who are holding gold for the long term and those who are just trading it, maybe the ETFs there. Your perspective on this, I know a lot of guests have said that It's important, we see these maybe buying opportunities, but we shouldn't hope for gold to go up because it doesn't necessarily mean the world is in a good place there. Some of the other maybe financial ramifications of these escalating wars here. I know oil is a big thing that people are looking at that could cause a whole lot of inflation if the oil price spikes here. Your perspective on the probability of that?
Well, what have we seen in oil this week? We have seen oil come down tremendously over the last couple of weeks. 2 weeks ago, many analysts were going to oil is going to go to 100 a barrel, and it dropped. I'm trying to think if it closed at around 67 or $70, right around there per barrel. But it's been in a nosedive along with gold. The dollar was strong at the beginning of the week. The dollar has been excessively strong over the last couple of months. And so you want to look at that when you gear what these other commodities might do, especially the ones that are paired against the dollar, like the precious metals and oil. Uh, that's a very important component. But although the conflicts globally were thought that they would lead to really a tremendous spike in oil, we've seen exactly the opposite. And the reason I believe that's occurring is that what we're getting right now, especially in America, and I think for a large part in Europe, a economic contraction. People have spent a lot of money, they're starting to build some debt, and they're spending less. The economy's been slowing down, even though it's doing well in the United States. The GDP is not where they thought it would be 3 months ago. They were predicting 4 and 5% annual GDP. Now they're predicting 2 and 3%. And that is a dramatic change. So when economic scenarios slow down, the usage of oil slows down. And when you get supply and demand where the demand is decreasing, the price is typically going to move down. And I think that's what we're seeing right now in terms of oil.
And with respect to the financial ramifications of the war, anything else that people should be concerned about right now?
I just pray for peace, but those prayers have gone unheard. Um, I think what the Fed does in the United States is extremely important. Right now, there is a 90% probability. This is according to the CME FedWatch tool. And what they do is they look at traders' activity and they take a collective selection of what they're doing, whether they're long or short, the size of their positions to determine probabilities. And those probabilities have pretty much been spot on by doing that. The fact that gold was so heavily sold into this week is surprising, but traders with immense bankrolls, let's say, a conglomerate of traders that move in and start to move a market down, regardless of the backdrop behind it, will have the power to build momentum. That's what we saw this week. In terms of what we want to really watch is where is interest rates going? Because we've had mortgages come down a little bit this week. Yields have come down a little bit this week, and that was under the belief that the Federal Reserve is not going to raise rates again. I personally believe that what the Fed wants to do is end the rate hike cycle. I think they want to be done with it. They've gotten it above 5%. I don't believe we'll see it go as any higher than 6% if they do implement a rate hike. There was one statement by Chairman Powell over this week that I found very revealing, and that was that the Fed is only looking to raise rates one more time. So, but he also alluded that actually could be in December. And December, as I just said, according to the FedWatch tools, got a 90% probability of not having a rate hike. So it's going to be very contingent upon the inflation reports that come out between now and prior to the Fed meeting. And of course, the Fed always goes into a blackout period right before a meeting. I think it's a week or 10 days before. So we won't really get any comments. This week was full of comments. We had multiple Fed members addressing different audiences and revealing a lot of information. And it was hard to get a consensus except to say that the Fed members weren't really unified as to whether or not they thought there should be further rate hikes at this point. And overall, I believe that it is still more likely that the pause will continue at least until January's Fed meeting or March. And I think the rate hike cycle is pretty much over. But as the Fed goes, it's data dependent. And if the data shows that the pace at which inflation is slowing down begins to diminish, they're going to act. And they will act decisively and quick. We've seen that with 11 consecutive rate hikes from March 22 all the way until they stopped. And now I think they believe that what they've done, because we do know there's a lag in the market between when they raise rates and when we see the economic outcome of those rate hikes is in months and not weeks. As long as they see the data going down, what's inflation? It started at 9.1% March 2022. It's at 3.7% now. So you cannot in any stretch of the imagination say that these rate hikes haven't really gripped and taken hold. I know that mortgages out here in Honolulu, and I'm told across Canada, as well as the United States, are exorbitantly high. I shudder to think what it would be like to try to buy a property that I like with a 7% mortgage. And when you think about the fact that a year ago or a year and a half ago, people were getting fixed 30-year mortgages at 3% and under, those individuals, like myself, I refinanced it at 2.75. I can't get money at that price anymore. And because I can't, I will make sure that I'm satisfied with the property I live in. Because to buy the property that I want to move to, I'm not going to do it with a 7% rate. The only alternative is to get an ARM, an adjustable rate mortgage. And so you start slow, but when they ratchet up, if you aren't accurate in predicting what the rates are going to be 2 years out or 3 years out, you can really take a lot of damage with an ARM. So for me, fixed rate mortgages are something that I'm comfortable with, and 7% is not. So you're going to see continued decline in buying of new properties, and we've seen that. And I think that right now, if the economic scenario shows a slowing GDP and a slowing economy, we'll see oil continue to stay steady and not, in fact, spike up. Another reason we're seeing that is the US is such a large provider of crude oil at this point that we are not as dependent on the sources we used to be. This isn't something that only comes from Saudi Arabia. That's not where the petrol you're putting in your car. And then many people are moving to electric. Now, out here, electric is generated by burning oil, which is why I've gone all solar in my property, including my car. I think that that's what should be the goal of global citizens, is to move out of an oil-based economy and move into an economy that's based with renewables and clean renewables. That is the only answer if we want to save this planet. And after this week in the turmoil and the news is really when you want to start thinking of a more peaceful Earth that has the apex predator species, us, mankind, not being such takers and being cognizant of the fact that we need to take what we need to exist in a renewable and sensible way. And that would be my take.
Now, we do have some viewers' questions back on the topic of precious metals here. Thomas wants to know your perspective on the different exchanges around the world and how the market is pricing the price differently. As the Shanghai gold price is higher than the COMEX price, is anyone taking advantage of the arbitrage?
The macro and traders, not so much. The micro traders, absolutely. They're looking for any disparity between exchanges, and they'll even it out by doing that. That's basically what their function is. Also, when you look at the way that gold trades, it's basically 24 hours, 6 days a week. The only day I can relax is about 2 hours ago when it shut down in New York, because in our time, now that the clocks have changed, it closes in New York at 6 o'clock, and then it opens 1 hour later in Australia. And so that goes on 24 hours a day. So if something breaks fundamentally while the main trading is in China, China's going to react. If that's kind of eased, whatever tension got it there eased, you'll see the reaction in London and then a spike higher or lower in New York to kind of balance it out. The fact that there is such a widely traded market that's traded basically 24 hours a day, well, traded 24 hours a day, but almost 6 days, 6 days a week rather than 7, you will always get any artificial spike by a particular exchange balanced out as it moves through Asia or Australia, Asia, London, and New York.
Now, before we let you go, Gary, if we could kind of get a wrap for our viewers, those who might just be joining now. I know we're seeing a dramatic decline this week in gold, silver, and platinum. If you want to remind our viewers kind of your forecast going forward.
I think that this correction could very well be short-lived. I think that depending on the geopolitical climate, when it does bottom and begin to move back up, could take a move back to over 2,000 in gold. Silver's been a funny kind of a metal in that it hasn't reacted in the same way gold has for safe haven, but there's such a high industrial demand that you see it working off of the cycles of that. I am cautiously bullish and acknowledging that at least for this week, we're in a deep corrective period. The question is, when trading resumes Monday morning in Australia, will we see the market spike up or will we see continue down? And then I look at different levels from there.
It will be definitely very interesting to see what happens this coming week. Gary, really appreciate your time. Where can people find you if they're interested in learning more?
Thank you so much. YouTube, The Gold Forecast. Our personal website, thegoldforecast, all one word, .com. And on Twitter, it's at Gary S. Wagner, one word, which is me.
Fantastic. Gary, thank you so much for your time and God bless.
Thanks so much for having me, and God bless too.